Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation show. I am your host, Whitney Elkins-Hutton, Director of Investor Relations here at PassiveInvesting.com. And with us today, we have a special guest, Shannon Robnett. Shannon, welcome to the podcast.
Good morning, Whitney. Thank you for having me on.
Absolutely. Well, before we dive into the details of the Jasmine, a 200-unit ground-up development, really interesting on how you did this, in Boise, Idaho. Talk to us about yourself, how you got into multifamily investing, and where you're at today.
I'm a second-generation builder developer, so I came by it through indentured servitude with my father as a young child. And my mother was a third-generation real estate broker, so it was in my blood. I've had my license. My son is a fifth-generation realtor, so we've always been involved in construction and development. And over the last, since 2001, I've transitioned from being a for-hire merchant builder to really just building for ourselves and investment grade opportunities. And we do a lot of ground up development. I've done over $450 million in closings where I'm either the buyer or the seller. And we currently have about $120 million under management and 600 doors in the pipeline to be constructed over the next 18 months.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy-day cash reserve with a high-yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
Well, let's jump into the Jasmine, 200 units in Boise, Idaho. Now, this is unique. So normally we're talking about acquisition, right? Somebody who's buying a multifamily building, maybe doing some value add or reorganization of the structure of the building and then re-tenanting it. Here, you bought a commercial property actually and are converting it. And it's much like a deal. We have a deal called the Riverside in North Charlotte that is similar to this, but we bought it from a developer like you. So I'm really interested to hear how this all went down. So let's first talk about, how did you acquire the property? And did you use a broker? How did you hear about the property?
I've always found that broker relations are really a great thing to maintain. We do some things off market, but I would say the majority of what we do is through broker relations. And having been in our business for 27 years, we've got a lot of great relationships all over the nation. And a lot of times we'll see things before they happen in that regard from a broker, but this one was just acquired through that means.
Okay. So I guess my question is for you. So for most of the people here, they're looking at acquiring a multifamily building. What made you look at that particular property and go, you know what? I can do something with that?
Well, Whitney, the thing that I look at first and foremost is how does this deal affect our taxes, right? Because if you really look at it, I mean, most people can take advantage of tax breaks that will make them as much or more in the first 24 months as the deal itself will. And so I was looking at this because it's actually situated in an opportunity zone. And we were exiting another deal. And I thought, you know what a great way to avoid capital gains tax for a couple of years and then protect us in the future against additional taxes when we exit.
Oh, interesting. Okay. So you found this through a broker. Your overarching game plan was to take advantage of the property, the tax breaks in the opportunity zone to kind of punt on the capital gains and stuff like that. Let's talk about how did you get to an offer on this property?
Well, I mean, I like to come in with usually this one was actually listed. We had a price nailed down. I came in with a full price offer and I add the conditions so that it works better for me. So I added a little bit more due diligence and a few other things, but we were able to make a straightforward offer. The lady was an older owner. She was it's a 45,000 square foot warehouse. She was managing 6 tenants. She was getting older. She didn't want to deal with it anymore. And she was just looking for something that was fairly straightforward in a sale. And we provided that for her.
Okay, and what did you purchase it at? And what did you end up closing at?
We closed on the property itself at $5.5 million. So which if we on 200 doors is about $21,000 a door for the raw land, but the tax breaks in it make it much more attractive than that.
Okay. And we'll get to the tax breaks here in a second. And so what did you put in that offer? You said you structured it and kind of put some safeguards in it. Like, since you picked this up as a commercial, right? Like warehouse, a commercial deal, but you're going to be converting it. Like, how does that deal get structured? Do you have a typical 2 weeks due diligence, 30 days to close, maybe a couple extensions? What was the specifics on that timeline?
Well, one of the things that we looked at, Whitney, was this property already had tenants in place and the tenants were way below market. And so we knew that our plan B would always be just to literally double the rents and keep it as a warehouse if we were not able to get it rezoned. So we wanted to make sure that the tenants, we were given something called an estoppel certificate, which is basically a certified document from the tenant that says, yes, their lease is good. Yes, they like it. No, there's nothing promised outside. And I knew that would take her probably 45 or 60 days to get those for me. So our due diligence period was short, 3 weeks, but we needed those estoppel certificates to waive our due diligence to ensure that the tenants were staying. And so in that, I was able to get about 90 days of due diligence because of what she had to do and how I figured she would take care of it. And she did. So we were given about 90 days of time there. And then we had a 60-day closing from there where we put permanent finance or bridge financing on it to get us through the entitlement process.
Okay, awesome. So there's a lot to unpack here, but specifically on the due diligence. So you're picking up the building, you have this game plan that you're going to convert it into 200 units. Okay, you're going to rezone it and convert it, but you're underwriting the current tenants. What goes into that type of underwriting? Like, what were you looking for? What is physically you're looking for in the building, but also financially you're looking for in that?
Well, because this was already a warehouse and I do have a background in industrial, I have quite a few industrial properties. We wanted to make sure that if we could not get the zoning, because you go before different councils and you do different things, if we could not get the zoning, that this investment could, with rents raised, could be something that we could either resell in a short period of time with the raised rents and additional cash flow, or we could hold long-term with about a 7% cash on cash. And so when we underwrote that, we took the rents in the market, we did a market study of what existing other warehouse properties were currently leasing for and found them to be about 50% of market rate. And we also talked with the tenants and made sure that, hey, would you be interested in staying? And they were like, yeah, because it's so cheap. We let them know, well, rents would obviously go up at the end of their term. They were like, yeah, but we're established businesses. We like it here. So we really made sure that our backup plan was solid enough to get a 7% cash on cash for our investors, regardless of what happened. And then we began to underwrite to a known number per door as far as what our ground could cost us in the deal.
Okay. So on the physical due diligence, what are you looking for here specifically? Like when somebody's acquiring just a straight multifamily building, maybe they're looking to make sure that the electrical panels are all up to date, that there's no galvanized plumbing. Like, I don't even know where to begin on a warehouse. Like, what are you looking for here? Since that is a contingency back, right?
Right, exactly right. And the reality was with those estoppel certificates, it said that the tenants were accepting of them in the current condition. So we were actually setting ourselves up to take care of a lot of the due diligence should we not go to plan B. But in the event we were going to plan B, we were going to demolish the whole building anyway. So our due diligence was really simple. We needed a phase one and a few other little items that confirmed that the ground was in fact, or the building was in fact something we could get a loan on. So we had a financing contingency and really a phase one, and the estoppels was all we needed because the tenants in those estoppels told us, we'll keep renting from you in the current condition.
Got it. Okay. Now, thank you for, it's kind of piecing together.
Yeah.
We'll hear a little bit. Okay. So did you put any earnest money down on this property? And if you did, when did it go hard?
Well, that was another great thing about it was because of the owner's need to perform, we were able to we put $100,000 earnest money down, and it didn't go non-refundable until our due diligence period was over.
So that 90 days?
Yeah, it really worked out well for us.
Oh, interesting. Okay, let's talk about the financing on the deal, because this is interesting, right? You're buying a commercial building, a warehouse, but you're going to be converting it. Maybe, right? If you can get all the zoning done. So is there just one loan here? Are there multiple loans? Like, how does this puzzle get put together?
And this was really simple because all we needed to close was some bridge financing because there was already cash flowing tenants there. So we underwrote it that we got bridge financing at 75% loan to value or loan to cost at this point. We were able to get that bridge financing in. We got a 24-month bridge loan. So we're in place for the duration until we can get to our construction funding. And so we will actually go from bridge to construction, not the other way around, but we'll go from bridge to construction to perm and work through it that way. But we were able to get that with the tenant's cash flow without an issue.
Okay. So, and what was your interest rate? Was there an IO period, any walkouts, prepayment penalties, anything like that?
Because it was bridge on industrial and it was short term, we work with a company that I work with a lot. They can close in 2 weeks. We paid 8% interest in 1 point. It is interest only for the 24 months. And so it was a very simple loan. And the relationship that I have with that particular lender made it very quick and easy to close.
Awesome. Okay. So then tell me the next phase is rezoning. Have you kind of conquered that? Are you on to building the multifamily unit?
We have completed the rezone and we were approved for the 200 units. And so now we've finished our drawings and we're getting ready to go vertical with the project. And so we're right there at the cusp of taking it to the next level. And we're arranging our construction financing, raising the balance of the funds that are necessary, involving the LIHTC aspect of it, the low income tax credit housing aspect of it, and just pulling all that capital stack together. And we'll probably go vertical in the next 3 or 4 months.
Okay. So what goes into vacating the current tenants?
Well, that has to do with their lease expiration. You can incentivize them to leave like anybody can, but they have businesses. They don't really want to leave the location. Their rents are going to be much higher wherever they're going to go. And we just felt that it would be best to let those tenants run out. And they are all currently on the last, 4 months of their leases. And so they'll all be out very, very shortly. And we'll be able to move to the next steps on this.
Okay. So when you hit the construction phase, like how does that lending work there? Like what goes into the project at this point in time?
Yeah. Construction lending is a little bit more complicated because they want to see all the details. They want to see every invoice. They want to see all of that. So typically in construction, we take about 65% loan to cost. And so this project will likely ring the bell at about $80 million for the project itself, including land. And so we'll need to bring in about $24 million of those funds in our equity stack. And then we'll wind up with a construction financing that'll give us 36 months of interest only. And that will be pre-funded in the construction loan because they know it's not an income producing asset anymore.
Okay. So we'll get to the capital stack here in a second because you did raise funds from investors, but did you have a round one with the actual purchase and now a round two with construction? Is that how it's going?
That's exactly right. It's like you've done this before, right?
I'm picking up the clues. You're laying them down very well for me. Thank you.
Yeah. So we did that and we had a strike price of getting in at this price and getting out at that price. So we knew where our investors would be on that. They have the opportunity to roll into the next development, take their funds, whatever they'd like to do. And then we're starting our round two of capital raise on this project right now as we speak. And we'll be moving through that over the next couple of months.
Okay. So before we get into the stack, LIHTC is not a term we hear very often on the show. So walk us through what this all means. What is the end goal whenever you have the 200 units in place? What does this building actually look like?
Well, it's a 7-story building. It's got 3 elevators in it. It's got the first floor is parking. And so it's really it looks like a typical 7 or 8-story elevated building. So there's not garden style. There is a playground and a pool and all that stuff, but it's on the 2nd floor. So we've got some construction challenges there to take care of. But we really made it look very contemporary, and it fits with what is going to happen. It's kind of a segue between the industrial areas that are around us. We're right next to the mall, and will eventually become more of similar product. So we're kind of on that edgy industrial look.
So, thank you for describing the physical appearance. I was actually trying to drive at the LIHTC, because that's low income tenants, correct?
I'm sorry.
No, it's okay. I think sometimes when people hear low income housing, they have an image in their head.
Right.
And it's very non-proportionate to what's actually being built, because we've discussed conversion LIHTC deals, but we've never just heard about a ground up. So thank you actually for describing the building.
Sure.
What does LIHTC actually mean? Is it all the building going to be set aside for low income housing, or only a portion? How will that actually take out?
So what we're doing is we're taking the first 2 floors and we're converting those. We're creating a condominium inside the building. And so that will be 64 units that will be condominiumized and set aside for LIHTC. And the LIHTC, what they do is they take the average median income and they take the average rents in the area, and the government does this calculation and they say, okay, if you bring that product on at 60% of rents in your area, we will give you this many tax credit, dollar for dollar tax credits for you to go sell and raise the funds to cover the difference between what it would be worth at today's cap rate versus what it will be worth with our lower income tenants in there. And so it's a great way to front load your project with funds that don't have to be repaid as long as you adhere to the 30-year term that's involved in that. And you build out the product, it looks the same. We're not doing really any finish differences. We're just doing it on the first 2 floors. And we're allowing that to be part of our capital stack. And it really brings down our cost of capital. And then it also, when lenders look at that and know that you're LIHTC friendly, they also get incentives to do that. So our overall perm loan that we take this out at will also be at a preferred interest rate.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFIN Con happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFIN Podcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
Now, with interest rates historically bouncing around in the last 12 months, and we're not exactly sure when this ride will stop or ease off, how are you navigating the risk for your investors right now from bridge to construction and construction into perm, over this time period?
That's a really good question. We always build to an 8 cap. And so we have a margin there that we can withstand some compression. We're taking, a lot of people look at it and go, well, development, gosh, that's risky for all the reasons you just mentioned. But I would argue that in today's environment, it's actually a pretty good asset to be working in because you have built-in interest reserves. And those interest reserves are designed to span about 30% or 40% farther than what you are actually going to be needing in there because the bank, they don't want you to have to pull money out of your pocket to feed interest. So they're building in that interest reserve in all the costs. And you're winding up with a much larger interest reserve than you typically do in an acquisition style. And typically on a project like this, we will probably have about a $4 million interest reserve that will be paid out on the funds as we borrow them during construction. And so as the costs continue to rise and we spend more money, the amount of interest owed will be higher each month, but that will all come out of our interest reserve and give us enough bandwidth to get past the construction period into the lease up period very successfully and very safely.
Interesting. Okay, well, let's talk about the capital stack. How much did you raise from investors on round one? And how much said 42 million or 24 million on round two, correct?
Yeah, we will need a total of about 24 million in additional capital in phase two. We believe we'll get about 9 million of that from the government tax credits. And so our end result will need about 15 from our investors. And that's with about a 7% contingency for cost overruns and things like that, which has been a very solid margin that I've been able to hold in my 27-year career. So we'll have a construction loan up to 65% with that interest reserve in it. Then we'll have the 8 million in government funds that will be, or 9 million in government funds that will be sold for tax, or the tax credits will be sold for funds. That will get spent first. That is a non-repayment item. So the interest on it is really good in this environment. And then we will go into our investors' capital being spent, and then the bank funds will fund at the end. So we'll probably have the first 9 months of the project, we won't really use any of the bank's funds because we will spend our capital first.
Got it. Okay. So what are your terms you're offering your investors? Like performance hurdles, tranches?
Sure.
What does that look like?
So typically we offer an 8% preferred return. That's kind of standard across our projects. We don't do a set waterfall. I believe that as a syndicator, as a general partner, it's my job to provide the best returns we can for our partners. So we do a step up as far as our partnership side, and we continue that from the 8% preferred, 12, 15, all the way up through 23% return. But typically this project would take from groundbreaking to stabilization would take about, we figure it at about 3 years. And so we will have some investors that would like to exit at that time. Some will go the distance because we'll hold that product for 10 years. But our investors that will exit in the appreciation phase, which is from construction to finished product and stabilized to perm debt, they will experience somewhere between 25 and 30%, even in the pre-2020 market that we've all just experienced and look like absolute rock stars. So it was really hard to find a bad deal during that time period. However, some of those that were purchased at that time period are now seeing different results. So we look at that as the risk reward ratio being slightly higher because it is development. There's no cash on cash being distributed during the construction period because it's a spend. So we know that preferred will carry to year 3. We'll do the catch up and then we begin our distributions from there.
Got it. And then what kind of, on the GP side of things, 2 things. I'd like to kind of understand the splits on the GP side, but also what kind of fees are you taking as well?
I personally take a developer's fee because I develop the project. So there's a 5% developer's fee involved in the project. It's all figured into the cost. And then we have Vertical Equity, which is another company of ours. We take a 3% acquisition fee on the deal as well that's paid at the end when it's refinanced. And then we take a 1.5% asset under management fee during the course of construction. So we try to keep our fees down.
Gotcha. So one thing that I want to kind of make sure that we really tackle here, because a lot of people that are listening to the show are newer into multifamily real estate. And so they're just trying to get into their first or maybe second multifamily deal. What words of wisdom or advice would you have for somebody who's enamored by what you're doing, saw the potential with a commercial building, with a warehouse, and wants to convert it and says, well, maybe I can't compete on a multifamily deal, but yeah, there's plenty of warehouse convert space here. Like, how would you kind of mentor them, I guess?
Well, the first thing I would say is know thyself, right? What are you capable of? I know a lot of people think they've watched HGTV and they can do this. This isn't really, I don't want to say this isn't for beginners, but it's really a little bit more complicated process. The bank really looks at our resume. They look at how many projects have you completed? What kind of construction have you done? Does this fit in your bailiwick? is this going to be something we would have to take over? Because banks are in the business of loaning money. They don't want to be involved in a process of repossession. And so if you see that, the first thing, and that's not you, go find someone that does that. Go find someone that's interested in that and become important to important people with the deal in tow that says, hey, this is what I found. This is what I think might work, to where you can offer that as the carrot to get you to ride shotgun on a GP deal because you were able to bring the underlying deal itself and get to see how someone gets that done and then get to add that to your resume.
Strategic partnership. I love it.
Absolutely.
What about somebody who has kind of the chops for this? What specifically would somebody be looking at? Like, is there a kind of like a buy box, but like a specific type of warehouse or situation that's ideal for this type of conversion?
Yeah, where you find older industrial areas is usually where gentrification is beginning to happen. And cities and towns have moved into different areas. They've expanded over here. The comp plan has changed. And I think the first thing I would do if I were someone looking at this is I would go to the city that you're looking in and identify the comp plan and see where they've done a lot of rezonings in a certain area. That means that the city wants this growth to change, because when you look at the tax base of industrial versus the tax base of multifamily, cities love the difference in the tax base because multifamily is obviously taxed much higher because the value is much higher. And they want to convert these older areas of town into new and vibrant suburban areas that have different feels and different features than the worn out old warehouses. And so I always look at that and kind of stay on the cusp of the edge of town between where the people currently live and where the warehouses are, because usually that's where people live close to jobs. And so you just kind of creep into that area and watch where the gentrification is happening. And you're able to find very different deals because there's not a lot of people competing for an industrial building versus a multifamily deal. And so you're able to stand out without being too obnoxious about it and offering the moon like we've seen done over the last couple of years, because it is a very cut and dry deal.
Mm-hmm. Now, conversely, what about somebody coming into the space on the other end? This development has already happened. Like, do you have any words of advice for them? Maybe they're picking up from a developer like you, like 3 years or 4 years into the project. Do you have any words of wisdom for them?
The thing that I really enjoy about when you look at what's happening in our economy right now, we're seeing that the D-class apartments are having higher delinquency rates. They're having higher or lower occupancy rates because people are struggling in that area and they're paying a larger percentage of their income, where typically the A-class and the newer apartments are seeing less of that. So you're really looking at an A-class apartment nationwide right now is consuming about 27% of the tenant's earnable income, whereas in the D-class, it's up in the high 30s. And so what I look at is owning new versus doing a value add. I think everybody can agree that value add is kind of at a standstill for right now, because a lot of what's going on doesn't lead to the rent pushes that we saw over the last couple of years. And financing is making that more cash intensive on the equity side. So at the end of the day, purchasing a new product gives you a longer window. So you're not having to move your money. You're not trying to create the value add, but you're able to create a cash flow from the beginning and know that what you were going to pay in repairs and maintenance and higher utility costs, you're able to offset into cash flow because you have a much better product that doesn't need as much as what you would find if you were doing something in the value add space, converting a C to a C plus or something of that nature.
Thank you for sharing that. So in wrapping up, what did you find easy during this process that actually ended up being a little bit more challenging? And then what was actually harder? What did you think would be harder that actually ended up being easier?
Well, the thing that I found that I thought was going to be easy that turned out to be harder was getting neighborhood support. The existing industrial area around us, they didn't want to see the change because then they saw that they would become the people that are now getting the noise complaints. They went from having this nice, quiet industrial neighborhood where everybody got up at 7 a.m. and started making noise. And sometimes they stayed late and worked on the weekends and nobody cared, that now they're going to be considered the bad guy, even though it's the new kid on the block that changed the neighborhood. And so getting them to understand, look, we're going to own this ourselves. We're going to manage this ourselves. We understand. Those were challenges that I didn't anticipate. But all things considered, I think we were able to overcome that. The thing that was going to be harder that turned out to be easier was actually getting the city on board. And when we went in with the project, I took the approach of what do you want to see here? And I just asked them, And I sat down with the planning staff and they said, you know what, we're really taxed on low income housing right now. And I said, well, if I could bring an element to that, would that help? And they go, wow, that would help a lot. What else would you like to see? And so I just really began to play the game of let's make a Christmas list and see what this I can give you. And we really got to a place where we had the full staff support. It was easy to sell to the mayor and city council because we really looked what the community needed, what the city wanted to bring to the area. And we tried our best to meet all those goals and we got really close.
Awesome. Well, Shannon, thank you so much for sharing your knowledge and experience here with us today. If listeners want to find out more about you, how can they reach out?
The easiest way is just find me on my website, which is shannonrobnett.com. There's a contact link there. You can contact me. I'd love to spend 15 minutes on a phone call, getting to know you and see if there's something else we can do to provide additional education for you or your listeners.
Excellent. Well, Shannon, again, thank you so much for sharing your time here with us today. We look forward to hearing about the future, maybe of this deal.
That'd be great.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit passiveinvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's passiveinvesting.com. Thanks again for listening, and we'll see you on the next episode.